Most MICs are structured where you have the fund and you have the fund manager. The fund is where your shareholders are situated, and typically their returns are based off of the lending rate and sometimes some fees that are generated through our lending. Whereas we are one entity, there are no other entities. Every single cent that is earned through rate and fees go into that entity. Every single expense that's borne by that entity, employees, salaries, overhead, everything is within that one entity for us, which is unique.
Hey everyone, thanks for tuning into the Canadian Private Lenders Podcast, a show covering the private lending industry, the mortgage broker space, and the Canadian economy. Your hosts are Neal Andrino and Ryan and Neal. Enjoy.
All right, everybody, welcome back. It's episode 75 of the Canadian Private Lenders Podcast with your hosts, Ryan and Neal. Neal, let me guess, you're tired and you're coming back from a trip somewhere.
As always, I'm slightly less tired now. It's been a couple days, but yes, I don't know how you knew. I went to Florida for a little bit.
Read your mind.
Yeah, and I got more trips coming. But anyways,
okay.
Business is done on the road, if I've learned anything.
Speaking of trips, we're going to take a little trip out west today. We've got this is our first lender actually on the West Coast. So, or maybe not, I don't know if West Coast is the right way to Western Canada. Let's do that. So today, we're super excited to welcome Jesse Bobrowski, the Vice President at Calvert Home Mortgage Investment Corporation. So Calvert is a private boutique lender operating for more than 46 years in providing specialized lending products in Alberta and Ontario. Calvert specializes in short-term financing for real estate investors, which we're going to get into today. Jesse, welcome to the show. Thanks for joining us, man.
Yeah, thanks for having me. Appreciate being here.
Awesome, buddy. Let's just dive right into it. I always want to know, a bit about your background, how you fell into private lending. Everybody's got their own unique story. Maybe you could touch on that and also kind of dive into Calvert's history as well. Yeah,
for sure. So maybe I'll start off with Calvert's history and then get into mine. So we are actually celebrating our 50th year as a business this year.
Okay. Wow.
We are 44 years as a mortgage investment corporation. Prior to that, we were a mortgage brokerage, and our founder, Everett Keller, shifted from brokering mortgages into lending mortgages back in 1981. And yeah, we are just that, a mortgage investment corporation. We focus on short-term lending, and we define short-term lending as anything with a likelihood to exit. And I know that's difficult to define, but whether it be through refinance or sale, that's how our clients are exiting us. And within that short-term focus, it's residential, urban areas, and about 60% of our borrowers are real estate investors who are buying residential properties, typically adding value through renovations, adding a unit, whatever it may be, and then they're exiting us either through sale, so for profit, flipping, or through refinance, which we refer to as the buy, renovate, rent, refinance, and repeat model, where they're buying underutilized housing stock, the old BRRRR, underutilized housing stock, which is my sale term for a piece of crap house that is probably usually not been touched in 40 plus years, usually has significant deferred maintenance. The market as a whole doesn't have much demand for it, so they're able to buy at a relative discount and add value and either sell for profit or refinance as part of their rental portfolios. And then the other 40% is just short-term opportunities. Typically, it's something where they're very close to bankable and maybe their credit's just not there. Maybe they just switched a job and their income history is not there. Maybe they're newer to Canada. We take on those. We work with the broker where there's an exit plan and set the borrower up for success to exit. So if it's a matter of, okay, they just switched their jobs, they need 90 days, the income, perfect. Fund it. Then they go and show the bank your 90 days and get rid of us, or new to Canada, or credit is often the case where maybe they bought a new car and they don't debt service, or maybe their credit dropped. Our underwriters always look to, okay, how do we fix this? And create a management plan to get rid of us. So that's our business. Yeah, a little bit of background on me. I've been in mortgage lending essentially my whole career. So I moved to Calgary, Alberta in 2007, went to university in Ontario, degree in honors Bachelor of Commerce, Finance, moved here to pursue a career in trading. And when I moved to Calgary, I bartended back in Ontario and I loved it. Like working the bar at, fancy steak joint, meet a lot of cool people. So I did that for the first 2-3 years in Calgary. And it was just that, an amazing way to meet people, keep me out of trouble somewhat, make a little bit of money. And when I was doing that, there was a husband and wife that was doing syndicated lending that always came in. And they were really passionate about their business. And I was really curious. I was like more curious out of skepticism, right? Like this was early signs of the mortgage crisis in the States. And I was kind of following that. And in turn, I was poking and trying to understand the business more. And as I understood the business more, I understood that, man, this is a great service. And I'm like, holy shit, why wouldn't the banks do this business? And I get it. It's just outside their box. Banks and A and B lenders are built to process transactions smoothly and for their underwriters to follow very specific guidelines. So then I started working for them, part-time, consulting, full-time. Fast forward 9 years, we had built the business, tripled. I was looking to buy in long-term, couldn't quite agree on terms. I knew Calvert, the executive team, through industry events. We worked on some industry organizations together. In 2010, the mortgage investments and mortgages as an investment got wrapped in NI 31-103, which is securities regulation. So we had to create a regulatory regime for each MIC or syndicator around that. And I worked with Dean, our president and CEO, on that. And when it was clear that that my time at that firm was coming to an end, he invited an opportunity to work with them, which was 9-10 years ago now. Fast forward, we've grown 10x in that time and serving more clients. And we entered the Ontario market 5 years ago, and we've grown. We are serving more clients. We've had the opportunity to bring on a lot more shareholders and grow our amazing team.
Cool.
Nice. I want to start by asking some questions about Calvert, if that's okay. Just out of curiosity, so I've spent a little bit of time out west trying to understand their private lending marketplace, what it looks like. And a lot of the groups that I spoke with were very heavy in the industrial space, lending to the businesses. But then also there's a lot of lenders that seem like on farmland and resource land. Is that something you guys do at all, or is there a different fund, or has that ever been an interest? Or are you guys saying like we're staying on our land, it's all res real estate?
Yeah, so certainly there are opportunities in that space. And as an entrepreneur and leading growth for our company, I often get tempted, but we have a lot of rigor around, and like really we're in charge of managing risk.
Yeah.
And lending on land, lending on development, lending on industrial, commercial, you need a different level of expertise and skill set. So we've just focused on the residential space, and by focusing have become true experts in the areas in which we lend, which allow us to manage risk better. And when we look at growth, we just look at growth through that mindset of short-term mortgage solutions on residential properties in urban centers, and the total available from for market on that is massive. Like, we have Alberta captured to where we want it, and we see about 5 to 10% compounded growth here. But in Ontario today, we just finished our year end February 28th, and 35% of our lending was in Ontario. And theoretically, if we had the market captured, it should be 4x. So there's a lot of room for us to run there. So we're really rigorous on sticking with our lending strategy, our lending guidelines, and just rolling that out in Ontario.
Would you guys be comfortable, Jesse, having more of your portfolio in Ontario than in Alberta in the long term?
Yeah, we're comfortable having our portfolio where the fundamentals are strong. So by fundamentals, it's like, okay, what is the, on the macro side, the economic outlook for those markets? On the more micro side, what does supply and demand look like? What does affordability look like? Certainly in Ontario, affordability is a lot tougher than Alberta, so we're really happy with having outsized portfolio here. But based on a holistic risk perspective, we're very comfortable lending into markets in Ontario that have the right dynamics. So on a population basis where Ontario is 5 times the size, we're confident that we should eventually have more capital deployed in Ontario than in Alberta.
Cool.
Even with the huge growth you guys are facing right now
in Alberta.
Yeah.
So to me, with the growth that we've seen in Alberta, that's helped us grow Alberta business. Absolutely. But having it so outsized in Alberta versus the opportunity in Ontario. So let's say we equalize Alberta with Ontario within the next 3 years. We're super comfortable with that. And then we just continue to look at the macro picture. And what we've seen here in Alberta is things move often and dramatically, right? Like, we've seen, basically every 8 years where values move up and then come down fast, and then move up and then come down fast because of the nature of our economy, which is still resource-based. Alberta is diversifying into tech, whether it be ag tech, whether it be fintech, whether it be energy tech is probably going to be the natural driving force. But we are capturing that growth in Alberta, basically.
So do you feel like, with the larger population base, and do you think there's more stability or liquidity within Ontario? Because I feel like from my perspective, there might be a compression on return. And I guess, is that reflective of the fact that people feel that there's less risk, or like, how are you guys seeing? I'm just curious to see what that interest is. And I'm not questioning, I'm more just curious.
I think it's so market dependent. Like, like Ontario is such a large population base. So in Alberta, really, we lend in Calgary and Edmonton.
Yeah.
Right? That makes up 60% of the population. And that's where we want to be because of liquidity, because of supply and demand factors. And then, you look at Ontario, and there's a lot of cities where we're comfortable lending. And those market dynamics we pay attention to, but then there's also competitive forces. So on the whole, there's more alternative capital flowing into Alberta, into Ontario. Like, there's more concentration. So in turn, there's a little bit of compression on what we can charge, where we're just starting to see companies come into Alberta again. Like we had a ton of competition up until 2014. Then that competition got their asses kicked because the market came down and stayed depressed for a 7-year period through 21. And now they're starting to come back. So we just plan to continue to do our best to, I refer to as, dominate Alberta, where we want to be, and grow Ontario.
Interesting.
Love it.
Makes sense.
Couple of questions back to Calvert Home Mech here. So you mentioned, 50-year history, incredible. And I know you guys have been a mech since your early days, right? So do you know whether Calvert was one of the first mechs that existed in Canada?
It's a really good question, and something that I should really look into as we celebrate our 50th year. So I suspect we're one of the pioneers, but I don't have specific stats on that. I'm going to get back to you because I'm going to promote that. But yeah, we've been Since 81, we've been registered as a mortgage investment corporation.
If I recall correctly, I think MICs were introduced into Canadian legislation in the 70s at some point. So I got to think you guys were one of the early adopters there. That's super cool.
And it makes me think, like, has there been any MICs that have been operating for that 44 years?
Yeah,
like
cool to know.
You know, they come and they go, but has any had that consistent longevity? And now, you know, through whenever he founded it with a couple capital partners, and then they gathered sufficient shareholders to qualify as a MIC. But for the first essentially 20 years, they operated it as that kind of family office type owned capital company and just grew as their capital compounded. And then when Dean, our current president, Ev's son, came in as president, he saw a vision to grow this to help more borrowers and more shareholders. And then we expanded our shareholder base over the last 22 years, specifically over the last 10.
Cool. Another question on the MIC here. So I know last time you and I spoke, you talked about the unique structure that your MIC has, where your employees are actually employed by the MIC versus most MICs in Canada have an administrator, typically a related company. Like this is how we structure as Keystone MIC. We have an administrator company, and we're actually employed by the administrator and paid by the administrator. So I'd love to hear you talk a little bit about this and kind of why you guys chose this structure and what the benefits and disadvantages are here.
And for listeners, just to clarify, so what Ryan just said there, we have an administrator that basically manages and runs the MIC. So the MIC is almost a flow through where the capital it comes in and passes through to our investors, and the administrator is the person who operates it, and that's our group, and that's where Jesse's is a little bit different, and they have their staff within the MIC versus having it in a separate management firm almost.
Yeah, and just to finish that thought, so we, as an administrator, we actually charge the MIC a fee for us to operate that, which allows us to basically keep the lights on and pay our compensation.
Yeah.
Yeah, so our structure is unique. To put a bow on your point, most MICs are structured where you have the fund and you have the fund manager. The fund is where your shareholders are situated, and typically their returns are based off of the lending rate and sometimes some fees that are generated through our lending. Whereas we are one entity, there are no other entities. Every single cent that is earned through rate and fees go into that entity. Every single expense that's borne by that entity, employees, salaries, overhead, everything is within that one entity for us, which is unique. It has pros and cons for sure. And I would say some pros that I love are the transparency to shareholders. Like they get to see every cent that goes in. They get to see how much we're paying ourselves and our people through a management and MER. They get to see all of our earnings. And in turn, I believe that there's additional alignment through that structure in that we're not earning anything not risked with our shareholders, right? Like everything that we do, win or lose, our shareholders participate in. Now there is some risk around like governance. We manage that risk by having a predominantly independent board. The only non-independent on our board is Everett. He's the chairman. And then we have 5 others who are outside of industry, have significant board experience, who we, as executive, report up into. Additional elements to help us with the governance pieces, we do use leverage from the banks. So we have a large credit facility. And I won't say it's governance, it's more rigor around our lending, where we have to report to them on a monthly basis on our portfolio and arrears, losses, all that stuff. We also have an annual audit from them. And then like any other MIC, we'll have our auditors who come in and just ensure that we're adhering to financial accounting or standards. So to me, the biggest benefit is around that alignment. And then that alignment is further driven in that the bulk of our variable compensation for our employees are related to shareholder returns. So the more we're returning to shareholders, the more they're getting compensated. And we look at it in a sustainability model where we build out a risk-adjusted return threshold that we think we should achieve to our shareholders, and then try to sustain that for a long time. Other benefits are MICs are required to pay all returns every year to shareholders and not retain earnings. So on the sustainability piece, it makes us think about how are we going to invest back in the business? Whereas with the management structure, we would get to say, oh, how much do we get to earn? And then you're conflicted a bit like, do I really want to invest this $1 million into an ARP system? Do I really want to invest this 300 grand into automation, into setting up data pools for machine learning, which we're doing in real time and are almost forced to do when we do our budget, because we say, okay, what is the right amount for shareholder risk adjusted return? And what is the right amount to ensure that we're creating sustainability and growing enterprise value year after year? Now, the disadvantages are, we talked around potential risk with governance having that black box. Certainly for ownership, with our board, we have a HR committee, and we have to report to them as if we're employees, and they say, no, here's what a comparable employee would earn, regardless of ownership. So we don't get to participate in those outsized returns per se. And then also it creates some barriers because now we have one entity that's regulated by the Securities Commission, that's regulated by the individual real estate councils. And in turn, we have to be a brokerage. We have to be an exempt market dealer. And sometimes rules around those conflict. So it sometimes prohibits us to advertise in certain ways or attack certain opportunities within M&A because of the structure.
To your point, it kind of like incentivizes reinvestment in the business every year because you basically have a capital budget that you would want to utilize. I'm just curious, for ownership, is there like a bonus structure then that they use that becomes almost reinvested back into the MIC, or is it just like a payout bonus every year that gets determined based on the performance? Because I'm assuming that ownership wouldn't just take like on a salary.
Yeah, we're employees. So ownership, the structure is there is voting shares for the company, but they're valued at the same share price as one share of our company. So if there were a theoretical exit event, they would share in the upside over net asset value.
Interesting.
But if there is none, then it's just vapor. There's no, okay, we have this enterprise value. We have net asset value, which is just basically 99.9% of it is the capital we have lent out, right? That's our share value. And it fluctuates slightly if we see a loss. And then when we exit that property and realize the loss. But for the most part, our company net asset value is the amount of capital we have out to the market.
There's no cash aside, I guess, except for money that's accumulated within the MIC. Like if there's months that it runs short to run your operations, like where would that cash come from?
So that to me is a benefit in that the cash comes from the earnings through our borrowers. So if the market completely is risk off, where, we're not comfortable lending, we're not seeing deals, we still have a pool of mortgages that are paying us, the face rate of our mortgage that we can draw from to sustain ourselves through that time. So, for example, in the financial crisis, early days, even through like Alberta got hit hard for that first year, and we essentially did no lending, and we're earning no fees, and we were still able to sustain the business and the employees through the revenue of the interest payments. We were able to protect our shareholder capital. Now their returns went down. We didn't lose, so they were happy. For the most part, their portfolios were seeing massive losses. So in times where business slows, because of the model, we really don't have to make drastic decisions there. Yes, we can lean up. Yes, we can cut costs, but we're not like, oh my God, how are we going to pay our people? We have a means to pay our people through the mortgage pool.
That actually makes sense. Yeah, I wasn't thinking about it like that.
It's cool. Yeah, it's pretty unique.
And Everett set it up for that reason, for the reason of when things are really bad, the management company structure creates additional stress because you don't have that income coming in, or it's trickier, let's call it. Whereas with this structure, we have that consistent income coming in that we can manage through times of stress.
Cool. Let's dive into more of your lending parameters at Calvert. So you touched on expanding to Ontario 5 years ago, very much urban residential focus. Can you kind of speak? Maybe you can first kind of touch on Ontario strategy. So is this all major urban markets? Like, are you in GTA, Southwest? Like would you lend in a Windsor or a Sudbury or an Ottawa? Can you kind of speak a little bit more to the Ontario strategy?
Yeah. So again, it's focused on residential, focused on urban. We love lending mid to lower half of the market. We don't like high end. And that very much fits our real estate investor needs. That's where they see opportunity. Like, not many people are flipping high end homes. Most high end homes, the buyer will buy it themselves and they'll renovate it to their needs. They won't buy call it on spec, so to speak. We love that mid to lower end because in times of stress, typically there's less compression in that area. And then there's always a floor to prices. Like, people always need a house over their head. So there'll be a floor. Whereas on the higher end stuff, it can fall drastically and sometimes be very hard to catch a bid at a certain price. And then as it relates to markets, we'll lend anywhere where we believe that there is liquidity. So there's buying and selling happening. There's not outsized supply versus demand. So with Windsor, for example, we lend there. And Windsor, coming off of the monetary easing cycle where monetary tightening happened. And by the way, the monetary tightening cycle in Ontario, which began March of 22, really hit values hard there. Mm-hmm. Like, on the whole, they're down 20%. Yep. Some markets more than others, some markets less than others, but they're down 20%. They haven't come up, which is unusual for Ontario. Really hadn't seen that in 20 years. We see that often, and we built our business to absorb that type of risk event. And as long as there is employment, there's people, and there's buying and selling happening without massive supply, we'll support those markets. When we see massive supply, we'll pull back. So we'll pull back on loan to values. We'll get tighter on what we want to see for our borrowers on profitability. We'll get tighter on our exit. Like sometimes you take a bit of a flyer. Oh yeah, they're going to increase their credit, but then it's like, let's just pull back a bit. So depending on what we see within the individual markets, and then even within, so we're talking Windsor versus a GTA right now. But like, even within Windsor, you'll have pockets where it's vibrant and there is a lot of buying and there is a lot of demand. And we'll take a more micro strategy on, this makes sense for us to do. So we're always using a make sense approach. And now we may not invest as much business and marketing resources to gain deals there, but we'll still absolutely do business and support good business in those markets.
Cool. And just to follow up there, so you mentioned earlier, you guys will take on anything with a likelihood to exit. So does that mean you'll go longer than 1 year? Will you do a 2 or 3 year term if it makes sense and you see the exit over that time period, or do you prefer to keep it shorter term?
All of our mortgages are written at 1 year terms or less. We're in the practice of not charging renewal fees. So, we'll check up at renewal, and if they're performing and they have a plan, we'll renew them. And even if it's, maybe a little bit of performance issues, but the risk is still sound for us, we'll renew them. We don't want to push them out. We try to really support our clients for their success. And if we see that there's a likelihood of success, and by pushing them out, we're decreasing their likelihood of success. We try to avoid that.
Interesting.
Cool.
On the capital side, you mentioned you guys have a lot of institutional capital. It sounds like you have a line, some sort of credit facility. Is that where majority of your capital is coming from, or do you guys have a big private investor pool? Is that changed over time? Like, what does that look like?
Our goal is try to balance that for the benefit of the business and shareholders. With our bank facility, the covenants around that are no more than 1-to-1. So we can never have more debt than equity. And then they have an interest coverage covenant, and we never want to borrow too much, right? Like we always want dry powder. Our business is really unique to manage in terms of the turnover. Like at any given time, we're lending out 10 to 12% of our book per month.
Wow.
At any given time, we're getting paid back 8 to 10% per month.
Yeah.
Sometimes those dynamics change, and all of a sudden we're sitting on way too much capital, or whoa, we're getting tight on our line of credit. So the levers that we use to manage that are, luckily we have built through our history a really sound pool of shareholders that are really sophisticated, mostly family offices, high net worth individuals, and some institutional investors. And we can go to them first when we're when we're raising. And then if we can't fill it through that, what we do is just say, hey, we're accepting outside money. Who do you know? And so we're lucky that those taps are relatively easy to turn on and off. And in turn, we can really optimize our capital stack for the benefit of our business and our shareholders.
Makes sense. So you're not, I would say basically in some mix, they're like constantly trying to fundraise, like little pieces here and there, always advertising. You guys aren't really running like that model. It's as you need it. You have a pool of investors that are strong. You say, okay, we're going to pull some from you guys. And then at the same time, we can probably increase a bit of our facility. And that'll give us some runway for the next 6 months, 12 months. And only if we really need to go back to that, are we going to go and re-raise at that point in time.
Yeah, that is basically how we run it. And as the leader of that piece of the business, my job is a lot easier than most of the industry, where we're forecasting that 2 years in advance. We're diligent on building that pipeline, setting good expectations on when we're going to accept, and bringing that in strategically.
Nice.
Cool. That's super interesting.
Sometimes it's like, whoa, business is booming. We have a huge opportunity. Let's go hard. We've had those instances, especially when we first entered Ontario. Like, it was way more hectic than I'm describing now. But again, through relationships, through trust, through our shareholders really understanding our business and us understanding our shareholders, and then being comfortable with risk, it's created a nice flywheel on the capital side, and then our bank partners as well. So that piece of the business creates a relatively low amount of stress and investment, and in turn allows us to focus on the task at hand, which is serving borrowers and brokers. So like if you go on our website, if you scour for us online, I'd be shocked if you can find anything about how to invest in us. It's mostly through our shareholders, and by you coming to us asking for information, we send you 5 years of financial reports. Our MD&A is massive. We try to report as a public company, and in a lot of instances, give even more disclosure on like specifically our portfolios, the loans on our portfolio, like as granular as where we're lent in each city, what those loan to values look like. Like, it is basically our Power BI dashboard that we use on a daily basis as executive. We give really good disclosure on that to our shareholders,
which I'm sure they appreciate.
Mm-hmm.
On that same note, do your investors, like you're saying, you're forecasting 2 years out? So are you literally approaching like a family office and being like, this will probably be our capital requirement in 12 months from now, or our next raise in 8 months from now, and kind of, okay. And you do find they appreciate like that? That's something they like to work with, knowing that they might have like a fixed income-ish opportunity coming down the pipe. Like, is that something that's been successful?
to be able to work together in looking into the future has its pros and cons, because sometimes they're like, oh, we need to deploy right now.
Yeah.
And sometimes it's like, oh, we need to deploy X amount of money right now. And we don't, as a company, don't want single name exposure risk in our lending portfolio or in our capital portfolio. So we're very diligent on not having more than 5% from a single shareholder outside of ownership in our pool. And as we've grown, we've become more attractive to that larger family office and those, I'll call it, portfolio managers. Problem with portfolio managers is they usually sit on massive pools of capital, and like to deploy $5 million a year over 5 years is not interested. So to find that those Goldilocks, or like where we fit in a private debt strategy and we're just a single slice, like, oh, we have this holistic private debt strategy and we want X amount in Canadian residential real estate. That's where we could fit really well. But going back to your question, we try to work with our clients to give guidance on when we're going to accept, and we invite their guidance on when they want to commit, and try to balance that as best possible.
Got it. That makes sense.
Yeah, super cool. Jesse, I want to touch on CAMLA, which we've talked about a few times on this podcast. I know Calvert's a huge proponent and supporter of CAMLA. And really, correct me if I'm wrong, but CAMLA exists as a coordinated voice for the alternative lenders in Canada. It's literally the Canadian Alternative Mortgage Lenders Association. And to be coordinated as basically a national voice. So I know you guys are heavily involved in that. So a couple of questions. Can you kind of talk about your experience there, and Keystone's in the process of joining CAMLA as well, which we're super excited about. But I've noticed most members are more Western focused geographically, or maybe there's some more in Ontario. But can you kind of speak to that as well, and goals for the future for CAMLA, if you know?
Yeah. So CAMLA is just that. It's industry organization for alternative lenders, where we try to be a unified voice around best practices, around managing rules and regulations, reporting into each other on like what we see collectively as the market, as how we're lending, and try to grow our industry in a unified way. The way that we've been involved, and even the way that it came to be. So we go back to earlier in the conversation where I met Dean and Dale through industry events. Back in 2010, when private mortgage lenders were captured under the securities regime, Dean and I worked as an industry group. We called it the PMLA, Private Mortgage Lenders Association. And that was really around Alberta. Alberta was we were regulated a lot more tightly around the Alberta Securities Commission because of alternative investments in energy and lack of disclosure, massive risk, bringing in capital that they shouldn't have brought in, like grandma with 50 grand giving all 50 grand. Our regulations here are unique in terms of a bit more tight than other securities regimes. So we built that to manage through this. And then fast forward, probably 15 years now, Dean, our president and CEO, spearheaded CAMLA to try to make it a national organization. Our industry as a whole continues to grow at an outsized pace than the rest of the mortgage lending industry. Being private, there are reputational risks. There are risks of bad actors. So by creating that unified voice, by sharing best practices, by sharing learnings, our goal is to raise the bar for our industry, better support Canadian borrowers and Canadian mortgage brokers. And Dean, we are a founding entity. Dean was part of the founding group. He sat as chair. I think this is the first year where he'll where we'll bring on a new chair. But yeah, we want this to be a self-sustaining group of alternative lenders because we see a ton of value in what we're providing to the Canadian mortgage market, to the Canadian housing market. And we think it's really important that our industry is well managed, protecting borrowers and investors, and professionalizing itself more and more every day.
Cool.
Nice. It's definitely needed at this point. So last kind of question I have for you is just on the Alberta marketplace. From what I'm seeing, and I have a few friends that are out there and what they're up to, it feels like it's blowing up, and a couple parts of Canada are not necessarily sharing the same experience. And it makes a lot of sense to me. Obviously, there's energy growth, and then with the tax base that Alberta runs, I think for people that are new to Canada, it makes a lot of sense to want to move to Alberta. But what are you seeing in the lending landscape, and then also just the growth perspective moving forward? I know you've mentioned a few times it's very cyclical because you're a resource-based economy, but as well every time you have these kind of booms.
Yeah, so here in Alberta, we are seeing significant growth in population. People are moving here en masse. They're moving here en masse because of affordability, because of the economic opportunities Alberta provides. Alberta is, I think, far and away, it's fair to say, the most business-friendly, most entrepreneurial-friendly province in Canada. Alberta has, for a very long time, been, on average, younger, more wealthy, and more educated than the rest of Canada. So we're really starting to see the fruits of that come to fruition in the tech sector. And then back to affordability, like for the most part, new to Canada immigrants will still land in GTA and Vancouver, but because of the economic situation combined with affordability, they're quickly realizing that this isn't what they had hoped. And now, as we're starting to get this pool of non-Canadian immigrants, they'll talk, oh, so and so moved to Red Deer, and it's really working for them. Like they were able to buy a house at $350,000. They're able to find a job that pays them $30 an hour. So that flywheel is starting to really run. So it's still mostly interprovincial, predominantly where we're seeing growth in population. And I think it's a great thing because we're seeing people that align with the Alberta values of, hard work and the right business environment should create economic growth naturally.
Nice. Yeah, that makes sense. Exactly. The affordability is a good way to put it because I think even we're seeing it here, like I think our house price is touching close to your guys', but the average income is nothing in comparison.
Not even
and
close.
The tax rate's a fair bit higher. So it just, the end of the day, your bottom line, what you have left in your account and what you can do with it is just not available. And so people are seeing that move. That's always taken place for Atlantic is they move out west to, I don't want to say greener pastures, but it kind of is.
Well, and we saw a bit of a reversal in that in kind of between 2017 and last year when things weren't as good for Alberta. Obviously, it's much commonplace for years for people all over Atlantic Canada, especially Nova Scotia and Newfoundland, to be moving out to Alberta, to the Fort McMurrays, to the Calgarys. And I also wanted to make a point, too, that we do lend in Newfoundland, which is very on a much smaller scale than Alberta, but very much, the boom bust type of economy as well with similar resource base there. So it's just kind of interesting to hear your take on that because we see that a little bit in that economy as well.
Yeah, certainly. Like from 15 to 21, we saw the exact opposite, where there wasn't much growth. There was dampened opportunity, and I'll say again, because of that, because of our demographics, those young, hungry people left Calgary, Edmonton, and our cities to go attack opportunities in Toronto and so on. So it's great to now have that economic environment where we can support very talented people. And now I want to leave this saying that hopefully, as a Canadian, as a country, we can wrap our arms around the opportunity for us to leverage our core competency, which is in resources. So whether it be mining for minerals, fish, agriculture, mining for energy, or forestry. I think it's a shame that for whatever reason that those opportunities have been demonized, and our provinces can't get along to create the infrastructure to move these products east and west and north. And we're so dependent on our American partners, where the world wants what we have, yet as a country we can't get our shit together to take advantage of this. So hopefully through this election cycle and through this uncertainty that has been created by our neighbors to the south, we can really as a country take advantage, because Alberta energy is if we're building pipelines east and west, that's creating jobs everywhere. There's a massive manufacturing base in the GTA that's supplying this industry. And through transfer payments, this is how we afford better healthcare, better schooling. And hopefully Canadians as a whole can wrap their arms around that idea, and we can have leadership that supports that.
Yeah, could not agree more with that, Jesse.
If anything, with everything going on south of the border, we're closer to it than ever.
Yeah, exactly.
Regardless of your political leans, hopefully the leadership will have a similar mandate around that.
Yep, absolutely.
We're not doing any favors to the world on an environmental basis, not supplying China and India with our energy and having them burn coal, right? Like,
it's a win on multiple fronts.
This is a global problem,
exactly.
Canadian problem.
Yeah, I got to bounce. So I appreciate your time, Jesse. It was very nice to meet you. I apologize. I have to run to an appointment right now.
No, I gotta run too. I got a meeting at 11. So this is great.
I'm gonna hit you with a bonus question as we wrap here, Jesse.
Very quick.
As Neal steps out, but we asked this to all of our guests, but wasn't on our list before. But we always want to finish up with pizza. Everybody's a fan of pizza for the most part, but this is our first time interviewing someone from out west. So can you tell us, our next trip out to Calgary, what's the best pizza spot in Calgary?
What's the best? There's a lot. And when you come, let me take you out west.
Sounds good.
So Una has been around forever, 15 years, and they're great. They have a few locations in Calgary. I know they've moved to other cities. I'm going to go Una, and then the other one, the name is escaping me right now, but it is amazing. The problem is you got to order it a day in advance.
Oh, wow. That good. Okay.
And I'm not going to promote them because I can't remember their name. And also, I think that they should open up the floodgates and not make it so difficult to eat their pizza. I forget their name, but Una's great.
Okay, Una, I love that answer. So we'll take you up on that when we're out in Calgary next. But Jesse, fantastic interview. Really appreciate your insight and your knowledge and experience in the not only in the Alberta market but the Ontario market too. Really cool to hear that. But anything else you wanted to add before we wrap?
Nope. Thanks for having me. Thanks to your listeners. Make sure to follow up so we can share this with our network as well.
100% will do. Thanks again, Jesse, and thanks everybody for listening today.
Thanks for listening, guys. It's Neal, your co-host and co-founder at Keystone Mortgage Investment Corp. and Director of Investor Relations. I'm also a real estate agent, real estate investor, and business owner.
And your co-host and co-founder of Keystone Mortgage Investment Corporation, Ryan McNeil. Keystone MIC is licensed under the Mortgage Regulations Act of Nova Scotia, license number 3000844, and through FCMB, license 89280. Keep in mind, the views of this podcast are for informational purposes only and are not financial advice.